Welcome back. Netflix is one of the most high-profile stocks in trading today. It reported better than expected earnings and subscriber numbers after the close of trading yesterday. Our next guest says she likes the stock. One of the things she likes is its advertising model. Let's bring in Elisa Reese, Vice President of Equity Research at Wedbush Securities, for her insight. Elisa, thank you very much for joining. Alicia, thanks very much for joining us on a story that's being watched by investors really around the world. First of all, your reaction to the huge number of subscriber additions, almost 19 million new subscribers to Netflix in a single quarter. And I believe it's the last time that Netflix will ever provide this metric. It's going to stop doing so.
Right. Right. They're going to be providing milestones, and actually hitting that 19 million was really advantageous for Netflix because that put them above 300 million globally. And so being over 300 million globally gives them a lot of breathing room to not have to give any subscriber metrics for a while, which also gives them some breathing room to just focus on revenue growth. And in order to do that, they're finally able to just not worry about subs, just raise the price across the board, across all of the tiers, and see what kind of price elasticity of demand they have around those pricing tiers. I think there's going to be quite a bit. I think what you're going to see perhaps is some trading down. Some churn, some trading down. The trade downs, though, is actually where it gets interesting, because if people end up trading down to the ad-supported tier, that actually gets Netflix to global parity on the ad tier versus its premium tiers. We think that it's already reached and beat, past ad parity domestically, because, the CPMs are quite a bit higher here domestically, but globally, not so. I think they still have a ways to go before they reach that parity. 2026 is the year that Netflix has said that it should reach parity for the ad tier. So this year it's the price increases that should drive revenue growth. Next year and beyond, it's the ad tier. So the sooner we get there, the better. With Netflix's content strategy and what they're spending on content, the quality, and also the diversity of the quality that they have across the platform is really going to keep a lot of people on that service, we think.
You used the phrase, or you cited a metric, CPM. Just what is that? What is a CPM?
Sure, that's the cost per 1,000 impressions. So anybody watching on the ad tier, the more impressions, the more eyeballs that they have on those ads, the more Netflix gets from the advertising partners. And so the ad partners want to pay as much as they can to get on such a hugely popular service like Netflix. And also they're able to reach consumers that are really hard to reach otherwise on that service, and globally as well.
Several years ago, there was a concern in the market that Netflix could only lose ground in the competitive space of streaming as other streamers, some of them with very deep pockets, Disney was one, and entered the market and ramped up their streaming offerings. Where do we stand now in the competitive landscape? Has Netflix outdistanced everybody?
Yes, they have, absolutely. Netflix had the first mover advantage. Competition was certainly a concern for a while, but instead of just sitting back and letting the competition come in and take market share, Netflix really pushed forward in a brilliant way with its content strategy. For a long time, it just went broad. It got as much content as it could, and the quality was okay at best. Now they've gotten, to the point of being profitable. So they have a lot more cash to spend on content. And as profitable as they're becoming, they're just leagues ahead of anybody else. And they don't have they're not hampered by, dealing with some linear channel aggravation, as linear channels kind of get they're going out of the picture really next to streaming. And also they don't have all the sports leagues that, are very, very expensive on content and really drain a lot of the resources of the other channels. And so they just have pure play streaming, and now they're getting into live events, and they can do some sports, and they'll continue to do some sports, but they're doing events, not these hugely expensive sports packages that a lot of the other channels do. That just leaves them room to drive a lot more traffic to their site.
Okay, the stock is now trading at 39 times expected earnings. What do you think of that multiple, and what do you think of the current share price? Would you be adding to Netflix positions as it trades today at its highest share price ever?
Yes. So for the first quarter of 2025, the guidance that Netflix gave, I think, is quite conservative, and I think it assumes quite a bit of churn. People seeing that higher price point and just removing from the service. If that doesn't happen, as we think it won't, we'll see some churn, but I do think we'll see more trade down. If there's more trade down, like we think, the subscriber number should be quite a bit higher, and the revenue per user is going to be quite high. So they could beat that pretty handsomely. If they do, and if they keep a lot of subscribers and they're able to really grow that ad tier, by 2027, the EPS that they can get with such a high contribution margin on all those incremental ad dollars and subscribers, really, I think Netflix could get, between 40 and 50 on EPS, where consensus, and we're around 35 right now. So the valuation gets a lot more attractive once we kind of see how that churn looks as we go into 2025.